Today we want to finish up the risk project, so you have everything so you can finish that. Hopefully we can get into credit risk and some of the other risk as well. Credit risk sounds like it'd be a huge discussion. However, in our class we keep it pretty straightforward. There's other classes like the fixed income class and some others that really get into credit analysis and credit risk. So we'll hit it pretty high level, and then other risk we'll hit pretty high level. But let's get into the final stage of our project and look at how we're going to finish up manager attribution. So last class we got fidelity set up in the S&P, and we discovered there is a data issue that I just cannot fix, and that is the fact that every December the Fidelity Fund has a large capital gains distribution. I like to use the Bloomberg because it adjusts for that, and this is pretty huge, and it's probably the entire reason why they're underperforming. So for your paper, you can acknowledge that. You want to just acknowledge, maybe put it in a footnote somewhere that this paper, the purpose of this paper was to go through the process of manager attribution, realizing that our database using Yahoo Finance had a flaw in how it handles capital gain distributions. I wish each of you could get your own data from Bloomberg, but it's just not possible. But we'll learn how to do it. So there's not a problem with understanding the concepts, and that you can do this yourself once you get your hands on really good data. I looked out on the internet, tried to find some websites that would adjust for it. You can certainly do it if you want. If you want to go back and try to do it, you certainly can. It's quite a bit of work though, and it'd be quite cumbersome to do it. But these mutual fund companies like Vanguard and Fidelity will often have databases that will help you with that. But for our purposes, we're just going to acknowledge that we have bad data, and we'll do the best that we can. All right, so what do we do next with this data? So one of my favorite analysis of managers is the upside downside capture, and so I want to set that up, the upside downside capture, and say we'll do the upside for Fidelity for you or whatever manager you're doing. We'll do the downside for Fidelity. Or, well, actually, I'm going to change that. We're going to do the upside for the S&P 500. Then we'll do the downside for Fidelity or whatever manager you're using, and the downside for the S&P 500. All right, so we want those columns set up. And so how do we do this? So we're doing this. Upside downside is referencing the S&P 500. When the S&P 500 is up, how's Fidelity doing? When the S&P 500 is down, how's Fidelity doing? And we're not looking at when Fidelity is up and down. We're looking at when the market's up and down, how does Fidelity do? So we're going to start off with equal if the S&P 500 is greater than 0, then give me Fidelity's return. Otherwise, give me nothing. Just put two asterisks in there. All right, I'll copy this up to the top so you can see it, and expand it a little bit just so it's not so small. So if C4 is the S&P 500's return for January, if that's positive, tell me what Fidelity did. We'll do the exact same thing with the S&P 500. The exact same formula almost. We'll say if the S&P 500 is greater than 0, in this case I want the S&P 500, otherwise give me nothing. All right. Exact same thing on the downside. We'll say equal if the S&P 500 is less than 0, then give me the Fidelity Fund. Otherwise, give me nothing. And then same thing on the S&P. If the S&P 500 is less than 0, give me the S&P 500. otherwise give me nothing. Alright, let me copy those up so you can see them. Now we're not getting anything because the S&P was up that month. But I'm going to take all of these, all 4 of them, and copy them down so you can see some negative months. Let's change these to percents. So you see here's a month where the S&P was down and Fidelity did really, really well. Here's a month the S&P was down and Fidelity did better. You can really see an early pattern that Fidelity tends to do better on down markets. Alright, so we've got our up and down capture. So what do we do with that? So we go down to the very, very bottom of this. We're just going to do equal average. We want to see what's their average in up markets, what's the S&P 500's average in up markets, what's Fidelity's average in down markets, what's Fidelity's average, what's the S&P 500's average in down markets. So you see too, Fidelity underperforms in up markets, although I think that's really influenced by those capital gains, but does better in down markets. Alright, boy, I wish we had real data because this is such exciting stuff. So you know you did it right is there can only be 2 things in each row. So if you have 2 things in the upside, you shouldn't have anything on the downside. If you have something on the downside, it shouldn't be anything. I love this metric because it shows you the kind of manager you have. If you have a high beta manager, that they're going for the fences, they'll outperform in up markets and they'll greatly underperform in down markets. If you have a low beta manager who's really worried about risk, they'll underperform in up markets, but they'll do really, really much better in down markets. So it's a great, great type of analysis to have. The last thing I like to do, and I also think it's a pretty good one, and that is what we call the batting average. So by the batting average, what we're asking is, what percentage of the time does Fidelity outperform? So we're just going to say equal if Fidelity's alpha, let me start on the right row here, equal if Fidelity's alpha, remember it's the alpha is in column D, if their alpha is greater than 0, give them a 1, otherwise give them a 0. Now we can copy that down. So we can just copy that all the way down. I don't know why it's not copying all the way down, but we can copy that all the way down. And then we'll go down to the bottom here. And the first thing we can do is just sum those up. And we can see that's 217 times. And then we can just count. Do count A and count all those rows. You can see there's 396. We give you all the formulas here so you can see them. These are very, very straightforward. Just taking the average of everything up there. Alright, so we have everything we need. On the upside, downside, you just look at the average of how they did in the up market versus how the S&P did in up markets. How they did in down markets versus what the S&P did in down markets. How many months did they outperform versus total number of months. That gives us the batting average. So we've got everything we need. So all we need to do now is at the very, very bottom here is just summarize all of this stuff. Alright, so let's start with just something we're going to need is number of periods. We've already gotten that, but we'll just go over and reference that. We did that on the batting average. So we have 396 months. Let's widen out A a little bit. Then let's do correlation. So the correlation, so this is fidelity and the S&P 500. We're not going to do the correlation S&P 500 to itself, so we're just going to do this for fidelity. We've already done that, but we'll do it again. Remember we did that last class. So I'll highlight all of these returns, comma, highlight all the S&P 500's returns. Remember that 0.83, so there's that formula. 83, that's an okay. It's probably, again, distorted by the capital gain distribution, so that's probably higher than that. The next thing we want to do is get the return. And for the return, we actually want the geometric average return, not the arithmetic. For the geometric average return, what we do is we take equal that 1893. Remember, the 1893 is the linked with $1, and we're going to raise that. There's 12 months in a year, so we'll raise it to the 12 divided by the number of periods. We'll lock in the number of periods there. Close parentheses -1. Change that to a percent. You can see that's 9.32. We can copy that over for the S&P 500. See the S&P 500, same thing, as long as you locked in the number of periods. So there's our return. We can now calculate the alpha. The alpha is just their return minus the S&P 500. Very straightforward. So there's your alpha. Their alpha is negative 1.68. That's probably not true because of all those capital gain distributions. You can see last year, I mean, there's 8% right there. And just that 1 year alone, you divide that by 12, that took 0.67 off. So their alpha may still be negative even with the capital gain distributions, but it's not that negative. So we're a little bit overstating it. The next thing we want to do is get their standard deviation. Very straightforward, but we're going to annualize it. So we want an annual number. So we're going to do equal STDEVP. We'll highlight all of their returns, but because these are monthly data, we're going to multiply it not by 12, but by the square root of 12, because you can't annualize standard deviation like you annualize other numbers. We can copy that over to the S&P 500. You can see their risk is right in line with the S&P 500, and it's probably, again, distorted by those capital gain distributions. So they may actually be lower risk in the S&P 500. I know you say, how is that mathematically possible if they own fewer stocks? But you know, they may be buying, they're contra funds. They're probably buying firms that are out of favor. The next thing we want is the tracking error. Now, tracking error, I'm going to expand this so we can see our titles a little better. Tracking error, for some reason, is not annualized. I can't explain that, but that's just the nature of the way we do this. I don't know mathematically why we do that. Tracking error is very, very simple. Tracking error is the standard deviation of the alpha. It's very easy. Just do equal STDEVP, and you just go over to their alpha column, and you just take the standard deviation of that, but don't annualize it. It's just the actual standard deviation. And then, so what we want is a lower tracking error versus a higher one. The higher the tracking error, the more uncertainty we have about the manager. If they have a high tracking error, then we have the risk, if these were true numbers, we have the risk of them really underperforming in a month. And what that means is if they beat the market, they have a positive 1% alpha, but their tracking error is like 8 or 9%, that entire alpha could go away in 1 month with one really bad month because they're taking so much risk. There was a fund I saw that was really heavy allocated to Tesla, And the lady running this fund was getting all kinds of great press. It was kind of like new innovation kind of fund. Boy, she got beat up. Her fund just got crushed when Tesla sold off and the tech stocks sold off. The next thing we want is the information ratio. What the information ratio is, it's simply alpha annualized divided by tracking error, and tracking error, remember, is not annualized, so it's kind of a strange number statistically. But we just take their alpha and divide it by their tracking error, and theirs is going to be negative because their alpha is negative. So what are we looking for? Generally on information ratio, great is anything above 1. So if you're above 1, that's great. That means for every percent of risk you're taking a percent. I mean, for every percent of return you're getting extra return, you're getting an extra percent of risk. So some people say, well, that's kind of balanced between risk and return. I'm not so sure that's true because your alpha is an annual number and your tracking error is a monthly number, but it's still, you're comparing your extra return to your extra risk, and you're getting a number. Information ratio has been the gold standard for assessing the performance of mutual funds for years. However, we've done some tests. Now, it's good information ratios, not with the distorted data that we have from Yahoo Finance. But even with good information ratios, we did quite a bit of analysis when I was at UTSA. And people think, wow, information ratios, just like your T statistic that you had in statistics to try to, tell you, is this statistically significant? The problem is, even when the information ratio is high and seems to imply there's a lot of skill with this manager, and that's what an information ratio is telling you. Does this manager have skill? The higher the information ratio, the more skill they supposedly have. You would think a manager with a high information ratio will be more likely to outperform going forward, and unfortunately, that's just not the truth. No, that's just not true. Managers with high information ratios are no more likely to perform better going forward than managers with bad information ratios. This is very, very frustrating. So what are ratios that do work? Well, the upside downside ratio actually has shown to have some advantage to it. So how do you do that? You just take your average. So it's actually not the upside down, I'm sorry, it's the upside capture. So ignore what I just said. The upside capture and the downside capture. We don't actually do a ratio. I guess you could. The upside capture, we just take our manager's average return in up markets versus the S&P 500's average return in up markets. We can see that's 85%. And then we do the same thing with the down markets. You just have to remember where the down markets were. You can somewhat tell just because they're negative numbers. So fidelity, what you want, the ideal, is that the upside capture is greater than 1 and the downside capture is less than 1. You're going to find, I don't know if I've ever seen a manager, be curious, there may have been 1 or 2. I've ever seen a manager with greater than 1 on the upside capture and less than 1 on the downside capture. That would be just the ideal manager to have. So what does this say about Fidelity? Well, it says that Fidelity must be a lower risk manager. They're somewhat controlling the risk, so they tend to do better in down markets. Their upside would probably be better if we could fix those capital gain distributions, but it would still probably be below 1. Now we can also calculate the beta. Now one thing I'll say about the beta, and this is something you have to be aware of, beta is always against the S&P 500. If you're not using the S&P 500 as your return, you'll need to add a column and put the S&P 500 in there because beta is always against the S&P 500. Fortunately, I'm using the S&P 500 for my firm. So I'm going to do, how do you do beta? It's equals slope Oh, before we do beta, let me do one more. I forgot about the batting average. Let's do the batting average first. Batting average is pretty easy. You just take how many times they outperform, how many months they outperform versus the total number of months. You can see their batting average is 0.55. That's 55%. In Major League Baseball, that would be tremendous. In Portfolio Manager, it's probably pretty decent as well. Now, I'm giving you the formulas. If you add a column for the S&P 500, then your columns will be off one, so you'll have to go back and see where I'm referencing. But hopefully you understand where I'm going to. K is where I have my batting average data. All right, next we can do beta. Beta is very, very simple. You just do... I tell you what I'm going to do. Because you may not have S&P as your comparison, I'm going to take, this fund goes back to 1988, so just know where you're going back to, January 98. What I'm going to do is do my batting average, my beta from this page. So you do equal slope and you highlight your fund. And then I'm going to do column, comma, and I'm going to go over to the face value asset returns, get the S&P 500, and find my starting month. Here it actually is January 98. Your fund might be January 1990. Find that and highlight the S&P 500. So I can do my beta from the S&P 500. That way you don't need to add a column. That makes it a lot simpler. So just do your beta by referencing the face value column. I just recommend that you do that. All right, so we got a 0.84 beta, which we somewhat expect, right? A 1 beta would be the exact same level of risk as the S&P 500. Now, why does beta matter? You would think, why would I want beta? Isn't standard deviation the right measure? Remember, standard deviation is total risk. Well, if this is your entire portfolio, then yeah, you would want to look at standard deviation. But if you're using Fidelity as part of a bigger portfolio and there's a lot of diversification, you might want a lower beta. Because you might find that you have a small cap growth manager and they have a beta 1.6, so you might want your large cap manager to have a smaller beta to offset some of that risk. So this is a lower risk portfolio. It will do better in recessions and do worse in strong markets. Since the economy is usually strong 4 out of 5 years, then 4 out of 5 years, you would expect to underperform. We can see they do underperform in down markets. However, their batting average is pretty respectable from that standpoint. They beat the market about 55% of the time. And we actually, when we did our analysis at UTSA, batting average was one of the strongest indicators of manager performance. Managers with good batting averages tended, it wasn't strong, it was maybe 52% of the time. It wasn't much greater than 50-50. But a slightly better than average, they would outperform going forward. So it was much stronger, unfortunately, than the information ratio, which most people think is the best ratio. It's amazing. This ratio has no predictive abilities, and yet it's the number one criteria people use to select managers. Now, what else could you do? So there are other ratios which I recommend that you bring in mainly so you just know what they are. So I encourage you to try to do at least 2 of these, if not all 3. But they're a little tedious, they're a little bit of work. So the most famous ratios are the Sharpe ratio, the Sortino ratio, and the Trainer. And I'm actually not using the right terms. The Trainer ratio, well, those are the right terms. The last one's a little bit different, and that's the Jensen alpha. So I've given you a document, I'll put this out on the blackboard, that shows you the most famous ratios. So the Sharpe ratio is really for your entire portfolio. It's used a lot by hedge funds. You wouldn't do this in our case where it's just one mutual fund that's part of a bigger portfolio, but hedge funds definitely use Sharpe ratios. So your Sharpe ratio is your return minus the risk-free rate over the standard deviation of your portfolio. We have everything there but the risk-free rate. So we need to bring in the risk-free rate. The Sortino ratio is your return minus the risk-free rate over the standard deviation of the downside. The trainer ratio is your return minus the risk-free rate over the beta of your portfolio. That one would make more sense for your portfolio. The trainer ratio makes a lot of sense if you're looking at a mutual fund that's part of a bigger portfolio. The Jensen's alpha takes your return minus essentially the capital asset pricing model. The risk-free rate plus your beta times the market return minus the risk-free rate. So what they're asking with the Jensen ratio is, and this is not going to work well with Fidelity because they don't have a positive alpha, but what they're asking is, okay, your portfolio has an alpha, but is the alpha large enough to offset for the fact that their beta is greater than 1, if your portfolio is beta is greater than 1. Now with our fund, I guess it could maybe make sense for our fund because we have a negative alpha. The Jensen alpha might say, well, your alpha is negative, but maybe that's because your beta is lower than 1. So you notice with every single one of these, we need the risk-free rate. So how in the world do we get the risk-free rate? And so, the key here is to bring that risk-free rate in. So, how do we bring that risk-free rate in? So I would say let's talk about the 10-year Treasury being the risk-free rate, and let's look and see if we outperform that. So how do we get the 10-year Treasury? So how do we get the 10-year Treasury? You could. So how do we get the 10-year Treasury? So you can go into, wow, the S&P is really rallying today. You can go into Yahoo Finance and just go over until you find the 10-year Treasury. There's the 10-year bond right there. This is the actual yield on the 10-year Treasury, so we'll actually use that yield. We'll get historical data. And again, we'll do the same thing we did before. We'll do 12/01/1987. Historical prices is fine, and we'll do monthly. I know it says we want yields, but for here the prices are the yields. I'll download that. And that gives us the number. The adjusted close and the close are the same. So we can just use the adjusted close. And we want to start January 1988. I want to convert these into actual percents. So I'm going to take that divided by 100 and copy that down, change it to percents. And then I'm going to copy this. So here's my risk-free rate back to 1988, the 10-year Treasury. I'm going to take that and copy it, take it over to our file, and let's go over on the other side of the batting average, and I'm just going to copy that right here as a percent. Make sure it lines up. I go down to the bottom. Well, we have January, February, March. I should have kicked those out. I go back to mine. Yeah, we don't want those last three, so I should have taken those off. So my last one, December, is 0.92%. Is December is 0.92%. I have that. So the first thing we need here is the risk-free rate. So I'm going to say the risk-free rate is just the average of those 10-year Treasuries. And these are annual numbers, so I don't need to annualize anything. So the S&P, the 10-year Treasury would have made you about 4.62%. The market risk premium, I'm just going to take the return on the S&P 500 minus the risk-free rate, and that gives me a market risk premium of that. So now we should have everything we need. So if you need some help, just bring this document over one piece at a time so you can remember. So we'll do the Sharp. I always get them confused between which one's using standard deviation and which one I'm using beta, but Sharp definitely uses standard deviation. That one's pretty easy to remember because that's the one hedge funds use. It's a total return. So you take the return of your portfolio minus the risk-free rate divided by the standard deviation of your portfolio, and there's your Sharp ratio. Now you'll have to look up, I'm going to let you look up on the internet what a good Sharp ratio is. So this is the part of the paper I want you to do your own analysis and look this up. So there's your Sharp ratio. The Sortino ratio I'm going to come back to. So let's do the Trainer ratio. I misspelled trainer. Trainer ratio is very, very simple. It's almost the same as the Sharp. So you're just going to take the return of your portfolio minus the risk-free rate. That's the return of your portfolio minus the risk-free rate, but now divided by the beta of your portfolio. So there's our beta. And again, I'll let you look up what is a good trainer ratio. And then the Jensen alpha, this one's a little bit more work, but we can handle it. It's not too bad. It's just a little bit more calculation. So if you just think of the capital asset pricing model, it's just not really that difficult at all. So portfolio return, I don't know why it gave me a question mark, but portfolio return minus, I don't know how it lost that. It's kind of bizarre. But portfolio return minus the risk-free rate, so we'll do equal the portfolio return minus, and then we're essentially going to put the entire CAPM into the formulas. So the risk-free rate plus our beta, where's our beta, times the market risk premium, which is what the market return minus the risk-free rate. You can see in this case their alpha is still negative. Yeah, I don't know, Bill Gates, why you thought I would want to convert minus signs to question marks. Maybe he doesn't think I know what I'm doing, but those are minus signs. So here the Jensen alphas, it's not, their regular alpha was minus 168. Their Jensen alpha is only minus 0.67, and the reason for that is because their beta was much lower than 1. And so what they're essentially saying with Jensen, it did help them. They're still negative. It still helped them, but they weren't as bad as the original alpha showed them to be. The Sortino ratio, I'll leave that up to you, how you define downside. This essentially, the way I interpret the downside standard deviation, you'll have to set this up. So I'm saying do at least 2 of them, if not all 3 or all 4. Sometimes the Sortino's the least used of the 4. So if I were calculating the downside standard deviation, I would take any time Fidelity had a negative return, and I would just do the standard deviation of those negative numbers. What is the standard deviation when it's below 0? But you might look up So I'll let you do this, how to calculate semivariance, and you would actually use semivariance in the Sortino, all right? So I'm going to leave you on your own on those last few. You figure out which ones you can put in there. You have to do a little research on your own, not much. It's very easy to just Google what is a good Sharpe ratio. So you'll see all kinds of things that come up. You get some good pictures. What is a good Sharpe ratio? What is a bad Sharpe ratio? What does a 0.5 mean? So this is really simple stuff that you can look up on your own. I don't have this stuff memorized because statistics show, I hate to burst the bubble of finance, but statistics shows these ratios do not tell you anything about future performance of these funds. So just because someone has a Sharpe ratio of 1 doesn't mean that they will outperform going forward. And that's the only reason you want it, right? Historically, all I care about historically is what was my return. How much money did I make? The reason I want information ratio or batting average or upside capture, downside capture, or a Sharpe ratio or a trainer ratio or a Jensen alpha or a Sordino ratio, the only reason I would want any of those is to give me some insight into whether or not this manager is going to outperform going forward. And if the ratio doesn't tell me that, and I know most of academia teaches it that, wow, you want a manager with a good Sharpe ratio because they're more likely to perform well going forward. And this data simply does not support that at all. I've never seen a study. We did quite a bit of work. Actually had a guy working with us where all he did was go through every single ratio available and try to figure out which ones were statistically significant for predicting performance going forward. And the only one he found that actually had any power at all was the batting average. It was statistically significant. It wasn't huge. It wasn't a great indicator, but it was better. The information ratio was better than Sharpe, Trainer, Jensen. And you can see Sharpe, Trainer, and Jensen were probably not going to give you radically different answers. With Sharpe, we noticed that the contra fund had a higher standard deviation but a lower beta. So the Sharpe, they're going to look worse on Sharpe and look better on Trainer. But still, you're probably not going to get radically different answers which one of these you use. Unfortunately, none of them provide strong indication that a manager will do better or worse going forward. So that's it for the project. Hopefully these videos you can go back and forth. So again, let me just say on the project, this is a test to see if you can't own your own independently using your own resources, adaptability, flexibility, intelligence, if you can figure this out. If you can't, it's not disaster. It doesn't mean there's something, you don't have a mind for finance, because you are using my spreadsheet, and that does make things a little tricky. Some students are better at Excel than others. However, try to go as far as you can without wasting a lot of time. So I don't want you wasting 5-10 hours trying to figure something out. But if it takes you an extra hour or two to figure it out, that's far superior to you spending 30 minutes and then contacting me to have me fix it. You'd be better off spending an hour and a half, and you figure it out on your own, because then you'll learn it better. You'll know it better. But don't go 3 or 4 hours and you're just beating your head against your desk and you just go, man, I can't figure this out. So there is a point where you have to throw in the towel and say, okay, I got as far as I could go. And I'll be noticing that if I get students calling me on one issue over and over again, I'll send out an email with some help, or make another video with some help to help you get through those places students are really struggling. I've shown you every single thing to do step by step for the entire project, with the exception of those last few ratios and how you interpret them. So that is a little bit on your own, but if you can't handle that, if you can't Google and search something, then yeah, you're probably going to struggle almost any business job. So I'm sure all of you are capable of doing a quick internet search on what Trainer means, what Sharpe means, what Sordino means, and what's a good and what's a bad ratio. So let's get back to the class notes, And let's get into some of these other risks. Somewhere around page 28 of the class notes, it might be 29 or whatever, but just look for credit risk. Let's get into credit risk. So we spent a lot of time on interest rate risk and balance sheet immunization. Interest rate risk is a special case of market risk or price risk. So we spent a lot of time on price risk with value at risk and other things. And essentially your project is very much related to price risk. So that's why I did the project in the middle of that. Plus to give you plenty of time to work on the project. So now let's really shift gears and let's talk about credit risk. So remember our model. It's been a while since we've gotten back to the notes, but remember our model is define, measure, mitigate. So let's start off by defining credit risk. Credit risk is the risk that they owe you something, you've got a contract, and they fail to perform versus that contract. Now I'm real picky that it has to be versus that contract because there are bonds that have optionality to them, like mortgage-backed securities and callable bonds. They may actually do something you don't like where you lose money, but the contract allows them to do that. Someone refinances their house and you had a 6% mortgage with them and now they're refinanced at 2%. You may be really upset about that, but that's not credit risk. That's a really interest rate risk and price risk. So we're talking about someone owes you money on March 30th and they don't pay you. That's credit risk. It's also known as default risk. We're going to broaden it maybe a little bit and add in the concept that there's also spread risk. So what's the difference between credit risk and spread? And spread risk is part of credit risk, but default risk is the risk that someone actually doesn't pay you. They actually miss a payment. Spread risk is a little bit different. What spread risk is telling you is the risk that spreads widen because the probability of default goes up, even though there was no default. So spread risk is a little bit different. Spread risk is really a form of price risk. So these overlap. And you might have noticed this in your project one, your paper one. Spread risk is part of credit risk, but it's also part of price risk, because credit risk is someone doesn't pay you, but price risk is your bond price falls. So why did your bond price fall? Well, the bond price fell because this firm had something bad happen to them, and the probability of them repaying their debt has fallen, so their spreads gapped out. I think you could go put them in either category. You could put spread risk under price risk. I like to put spread risk under credit risk. I think it belongs better under there. And spread risk can be used. There were bonds dropping 40, 50, 60% in 2008 that never missed a payment. They never defaulted once, especially there were some commercial mortgage-backed securities that were perfectly fine securities that were dropping dramatically, over 40%. It was just amazing. So they had huge spread risk. Their spreads gapped out, widened out dramatically, and yet they never missed a payment. Obviously, you would have wanted to have bought those bonds when they dropped 50%. If you knew they were going to make every single payment, then yeah, man, buy a bond at 50 cents on the dollar, and then eventually get all your money back. So you've got a 100% return baked in plus all your coupons. That's a really good return. So that's spread risk. I make it part of this, but there are a little bit of difference between spread risk and default risk. They're both, to me, part of credit risk. Now, this is a huge issue for the Federal Reserve in 2008 because the Federal Reserve had to decide if firms like AIG and Lehman Brothers and Washington Mutual, the list goes on, were these liquidity crises. Liquidity crisis is a firm like Lehman can't borrow money because they've lost the confidence of the market, but if they could borrow money, they would survive. So if they could just get through this crisis, if they could just get some money to borrow for a few months, they would survive. It's a perfectly legitimate business. So it's a liquidity crisis, and the Fed steps in, provides them money, they survive. Or is this a credit problem? Is Lehman really bankrupt? And I think that was the case. Lehman had assets that were just not going to come back. They were horrible assets related to the subprime crisis. If the Federal Reserve bailed them out, then all they'd be doing would be giving taxpayer money to an entity that's ultimately going to fail anyway, and probably fell even bigger because the Federal Reserve essentially gave them life and allowed them to keep doing business and getting worse and worse and worse. So that's a main struggle. So the Federal Reserve decided that Lehman Brothers was a credit risk and shouldn't be bailed out. And then AIG, I think they thought AIG was a credit risk, that AIG really was insolvent, but AIG would have caused such a domino effect. I think the Federal Reserve thought they had no choice but to bail them out. Probably the same thing with GM. GM probably was the fault. Some people think Citibank really was an insolvent bank and got saved by the Federal Reserve. Other people disagree with that. So it just depends on your view. But the Fed has to figure that out. If the Fed has a liquidity crisis, but they don't bail it out, then they're going to cause this horrible domino effect of firms failing when there's no reason to. You give them a little bit of money for a few months and everything's fine. If it's a true credit crisis and they bail them out, this is somewhat what people complain about Japanese banks being constantly propped up by the Japanese government. If that's the case, then you're just harming the economy. You may be saving the economy short term, but you're causing tremendous harm long term. So it's a really huge issue. And obviously, Paulson got really beat up in 2008. Many people give him credit for doing a really great job. I'm not an expert in that area to say whether he did a great job or a poor job, but most podcasts I listen to, they give him great kudos for how he handled it. But it was tricky, you know. If you bail out a firm that's truly insolvent and it's a firm you used to work for, like in the case of Paulson, that's when you can get a lot of people, especially politicians, and on their sounding boards in congressional hearings. So how do we measure this? So the main thing we do is we measure it through credit ratings. And I gave you the credit ratings in here. Here's the credit ratings. You should know your credit ratings. What's a AAA? So S&P has all caps, and the letters are all the same. So AAA, BBB, that's S&P. Moody's uses caps and small numbers. So AAA is a capital A and two small A's. And they always use little a's. So BBB is actually BAA. You'll actually hear it as BAA referred to, and that's the Moody's. You should know which is which, whether you're finance or actual science. You need to know what is. And S&P is the norm. So if you're doing Duff and Phelps and some of the others, they look just like S&P. Moody's is the oddball in the way they do theirs. And so you look at AAA, extremely strong. AA, very strong. Single A, strong. B, get down into words you hope no one ever uses to describe you as an employee or as a child, a son or daughter, is adequate. Oh, my parents never described me as adequate. They definitely think I'm adequate on certain things that they see me do, like playing high school football, but you know, that sounds like a weak word and just means they got enough that they should survive. But boy, if we get into a recession, they're going to have struggle. When you get down to BB, you start looking at risk, higher risk. And they use this word vulnerability, which I have a tough time pronouncing. But you're just seeing they're getting down there. And then once you get down to the D, they are in default. They've missed at least one payment, whether it's interest or principal, they've missed a payment. So, you know, get familiar with these. One thing I'd recommend, especially if you're going to interview with a firm that has anything to do with credit risk, is Moody's especially, but S&P will as well. They have their annual default studies, and you can get them off the internet. And I would recommend you go and look at those default studies. They're quite powerful. I'm going to show you the results of those studies, but it's kind of an old chart. I don't have something more recent, just because I can't find this particular way they summarize it. But we're going to use it on the exam because it's a real nice summary. It's one that I think is probably still true today. I don't think the numbers have changed all that radically. So you can still use it today. So I'll show you what does a AAA mean, what does a single B mean, what does a double B mean. So we'll get some data there. So you have high quality, medium quality, and low quality. There are other measures. The Altman Z-score tells you if a firm is at risk of default. So if you get an Altman Z-score, and you can look this up on Wikipedia, if it's like 0.1, 0.5 or 1 or a low score, yeah, there's a good chance they're going to default. Once the Altman Z-score gets above 2 or 3 or so, it doesn't really tell you anything. So an Altman Z-score of 10 doesn't really tell you that that's any less likely to default than an Altman Z-score of 8. There's really Altman Z-scores above a certain level have no correlation to credit ratings. So that's why I don't really like Altman Z. Bloomberg's probability of default, which I really do like, it does have a high correlation to credit ratings. So I really like to use probability of default. And Bloomberg's probability of default is probably capturing very similar things, if not almost identical things, that S&P and Moody's are doing. The only difference is Bloomberg is not actually interviewing management of the firm. Bloomberg is entirely quantitative, whereas S&P and Moody's are both quantitative and qualitative. And I was heavily involved in the rating process for UTSA, did presentations frequently to the S&P and Moody's. In fact, I had a great relationship, especially with Moody's. I had a database that they really loved, and I would essentially work for them for free. And it gave me a great pre-look at a lot of their ratios. They were developing a new ratio, and they needed some help. And they would email me, especially on the insurance industry, and I would give them all kinds of information. My boss was fine with me working for them for free because it gave us great access. That's one thing you should think about in your career. It means a lot of overtime, no question. Oh my word, though, it gives you access to stuff that no one else can have. All right, so we need to look at historical data for the rating agencies. You can certainly go out and get their studies. So I just typed in Moody's Default Study 2019. We'll see what comes up. Here's a report right here, Moody's Analytics. Sometimes you'll click on pages, sites, and they'll ask you to log in, or they'll charge you money. I've seen these a lot where they're just summaries of the reports, and these can be very, very interesting. Look over on the right because they will have other information that you can click on. So it's really cool stuff. You want the actual report. Here's the transition recovery, which is a great chart. So look at all this data that they give you. Here's the default rates. You can see for investment grade, very, very, very low. Overall is heavily influenced by high yield, as you can see, and then speculative grade, you can see it. And, you look back at the 2008 crisis, it jumped up. We don't have 2020 yet, so it's hard to know what 2020 would have done. But and then they give you the annual data, speculative grade. It's the 91. You can see a huge year. In 2009, you see a huge year. Actually, the biggest year on here was 1991. But you see them, and they show default rates for investment grade, non-investment grade. The worst investment grade year, 2009, 2008 were pretty bad for the investment grade because you did see firms like Lehman and AIG go under. If you think back to the Enron, that was a huge one back in 2002. I think Enron was AA when their crisis hit. Now they were downgraded, so S&P and Moody's will say no AAA company has ever defaulted. That may be true, but they may have been AA, AAA 6 months before they defaulted. So I think that's a little bit of a lie. Obviously, if the firm has serious trouble, they're going to downgrade them really fast before they actually default on a payment. So the investment grade, we had quite a few in 2002, but Enron was the huge one there. But you see, there's a lot of years where there are no investment grade defaults. So 2002, that was the huge one. 2008, 2009, those were huge ones. But you don't see a lot. In fact, I think over half the years, it looks like over half the years, you have no defaults. So I encourage you, go out there and look this stuff up, see what's out there, what's provided. What we're going to do on the exam, though, is I'm going to show you this chart. I love this chart, even though it's a good 8 years old. I wish I could find this chart again, more current. Maybe on the exam I'll give you more updated numbers, but I seriously doubt they've changed that much because it does include 2008. And the years after 2008 and 2009 weren't all that big of years. But what this is this shows you the cumulative default rate for years 1, 3 years, over 5 years, and over 10 years. And this is what we're going to use for the exam questions. So we only get through credit risk today, and we'll have to finish it next class. But I want you to look at this. Is something I would actually carry in my wallet to know these numbers, because I think this is really powerful information. So AAA companies, none has defaulted 1 year after being rated AAA. After 3 years, and these are percent, so this isn't 3%, this is 0.03%. So 3 out of 100,000, whatever the numbers are. So very, very rare. After 5 years, 0.17%. Over 10 years, fewer than 1% of the companies that were AAA at the beginning of the 10 years, only fewer than 1% of them were in default over 10 years. For AA, it's a little bit higher. We're going to focus in on the 10 years, 2.5%. Single A, 3.6%. Triple B, 7.1%. You see they're using the Moody's. Then you jump down to speculative. Anything below triple B is speculative. So double B or BA, 20%. Almost 1 in 5 companies that are rated double B, almost 1 in 5 will be default 10 years later. Single B, over a third will be default 10 years later. And once you get down to the C, you've got a 50-50 chance. Over 50% will be default over the next 10 years. So here's the investment grade, about 5%. That's a great number to know. About 5% will be default, and you can see how the triple B really dominates that. There's more triple Bs than there are probably more triple Bs than the rest of these together. So just know that over 10 years, about 5% of investment grade bonds default. Over 10 years, about 30% of below investment grade bonds default. So you're much more likely, 6 times more likely, to see an investment grade bond default than an investment grade. So what are we going to use with this information? Now, one thing to make sure you get into your notes is this is only the default rate. So on top of this, you have a recovery rate. The recovery rate is, you think about with Enron, okay, so Enron went under, I had a default, but I'm a bondholder. I have a secured interest in this. The stockholders are wiped out, but I get to go to Enron, and they're going to go through and sell all the assets they can sell. And Enron had some very valuable assets. They're going to sell all the assets they had, and they're going to pay me back as much as my debt as they can. That may take quite a while. It could take years, but I'll get some of that money back. So your recovery might be 40-50%, especially for AAA. You may get 50%. So this 0.87%, that's your default rate, but you might get half of your money back. So your real loss may only be about 43-44%. Now your recovery rate's going to decline as you go down. For these single Bs, your recovery rate might only be 20-30%. And so what we're going to do, we'll do this in the next class, is how can we use this information. So I'm going to say you have a single A rated 10-year bond, and it's giving you a spread of 60 basis points. And you think your typical recovery is about 40%. So recovery rates are 60% for AAA bonds, and recovery rates tend to be 40% for all other bonds. So if you got a AAA bond, you'll lose about 1% of your bonds will default, but of those that default, you'll get 60%. You'll still get 60% of your money back. Now there is a time value money there because you won't get it back immediately. It may take a lot more than 10 years, but we'll just assume it's 60%. For everything else, well, this is a single A rated bond, so we use the 40% here. So single A rated bond. So first of all, single A rated, we expect about 3.60% default rate based on history, and a 40% recovery rate. So what spread do we need? Well, first of all, 3.62% is over 10 years. So we don't expect a default rate of 3.62% every year. We expect a cumulative over 10 years. So we expect in any given year to have a default rate of 0.362%, or 36.2 basis points. All right, so a typical year, we expect 32.6 default. So 0.362% of our portfolio are default. So we're going to take 36.2 basis points times, times what? Times the recovery rate? Well, no, because the recovery rate is what we get back. How much do we lose? We lose 1 minus the recovery rate. And our recovery rate is 40%. So 0.4. So if you do that math, so you take 36.2 times 0.6, you get 21.72 basis points. What is that number? Think about that number. We're going to get into this again next session. But this is the minimum spread we need to cover expected default risk. Remember, notice I didn't say expected credit risk, expected default risk. So this excludes, what did we say before? It excludes spread risk. All right? But if you think about it, we're getting 60 basis points in spread, but only need 21.72 basis points. So we are well compensated for default risk. So the extra spread will provide for spread risk. So if you go into a recession, spreads are going to gap out. If this firm has some bad news, even though they don't default, their spreads are going to gap out. Spread risk, which is a type of credit and or price risk. All right, so that's what I'm looking for in this particular exam question. So we'll get into this more next session. I want to just introduce it to you now so you can see what we're after. I might give you a second credit question so we can practice this a little bit more. Some students, when they get to the exam, they're like, it can't possibly be this simple. But it really, really is. And I definitely won't give you a recovery rate of 50% because then I won't know if you got it, if you did the formula or not. But make sure recovery is what we get back. So we won't lose 36 basis points a year. We'll lose 36 basis points, but we'll get back 40%. So we're only expected to lose 21 basis points. And this is true for all corporate bonds. The spread you get is always much higher than the average default times 1 minus the recovery rate. All right, so we'll stop there. That gives you a good introduction to credit risk. Next class, we'll finish up credit risk and maybe finish up most of the other risks. So we're not as far behind on the syllabus as it looks.